So, a few weeks ago, I released a video titled Why Dividends Are Irrelevant and Don't Matter. And unsurprisingly, it caused a huge hoo-ha among dividend investors. For the record, it's not that I hate dividend investing, yeah. The reason I made that video was to warn investors of the traps that can come with dividend stocks. Because after all, dividends are not free money. That's why in this video, I'll be diving into this a little deeper and show you what are the traps that you must avoid when choosing dividend stocks, what criteria you should focus on, and finally, I will also share my top 4 dividend stock picks so that you can use it as a starting point to further do your own research. But before I start, do join my 10,000 members Telegram chat group to discuss stocks and personal finance. Alright, the biggest mistake a dividend investor would make is to just focus on the dividend yield without understanding where the money comes from. More often than not, the higher the dividend yield, the more likely it's a dividend trap. Take for example, First REIT, a REIT that holds healthcare related assets in Asia. This REIT has a whopping 9% dividend yield. An investor who just focuses on the dividend yield would be thinking, wow, this is a very high yield leh. I will be getting 9% dividend income from this investment every year leh. But what he would fail to take into account is the declining fundamentals of the company. If you look at its financials, you will see that the company revenue has been steadily declining, while the net income has remained rather flat. But more importantly, its free cash flow has been going down. Free cash flow is the money that's left over after paying for operational expenses and capital expenses. Stuff like paying your employee, logistics, spending on new equipment, assets, and so on. Free cash flow is important because it shows its ability to repay its debts as well as pay dividends to investors. You can see that as a result of its declining fundamentals, the company had to keep cutting its dividend payouts. So even when you account for its 9% dividend yield, your total return would have still dropped by over 60% as compared to 5 years ago. The second mistake a dividend investor can make is buying into bad industries. And one such example is Singapore Airlines. But then some might say, SIA is Singapore's national carrier leh. They are one of the most successful airlines in the world. Surely, this is a company that's worth investing in, right? From a financial perspective, not quite. But didn't Singapore Airlines report record profits recently? Yes, this is because their passenger load factor, or the percentage of the seat capacity, has gone up from 82% pre-COVID up to 89% in Q1 this year. At the same time, their RASK, or revenue per available seat kilometer, has also gone up from 7.5 cents pre-COVID to 9.3 cents as of the last quarter. So when more people are flying and when SIA is charging more for each ticket, obviously they are going to earn more money, right? But realistically, how many more people can fly with SIA and how much higher prices can SIA charge? On top of that, they also have to deal with higher staff costs, higher capital expenditure, and a huge part of the expenses are tied to volatile oil prices. In fact, it seems like the net profit has peaked earlier this year. Plus, airlines are a competitive business, and unfortunately, SIA has no strong moat. If they try to cut costs, this will lead to lower quality and criticism. And if they try to raise fares further, people will just switch over to cheaper airlines that may offer similar or even better comfort. Because of this, you will get very choppy dividend payouts, where in some years, things will do well, while in others, you will get lower payouts. Now, this is not to say that Singapore Airlines is a bad investment, yeah. For all I know, the stock may just recover back to its peak one day. But this won't be an easy ride. As an investor, I would rather invest in something that is a lot more predictable, has a strong moat, and has a high certainty of doing well in the future. So with that in mind, here are some criteria that I need to have when investing into dividend stocks. Momo Singapore shares transfer in promo is now back. And this time, they are giving away an iPhone 16 128GB. But first, here's why more than 1 million users in Singapore are using them. Momo Singapore lets you trade stocks across Singapore, Hong Kong, China, and even Japan with zero commission and platform fee starting from as low as 99 cents per order. 2. Momo Singapore lets you transfer in your stocks completely online in just a few simple steps. And 3. Momo Singapore is licensed and regulated by MAS and offers a wide variety of investment products with just one platform. Not just that, Momo Singapore also offers 60 levels of free live quotes, company research data, advanced charting tools, discussion forums. It even lets you park your idle funds in money market funds to earn a yield with no lockup period. New users who sign up to Momo Singapore will get to earn up to $1,034 worth of welcome rewards. Plus, both new and existing users will get to enjoy zero commission for Hong Kong stock trading for 30 days. Also, from now to the 4th of November, both new and existing users who initiate their first stock transfer of at least 350,000 SGD and keep it there for 90 days, you will get an iPhone 16 120GB, limited to the first 60 customers only, and a $200 transfer fee subsidy. First, we want to avoid dividend traps. So, one easy way to do that is to look for stocks that are paying out a dividend yield of less than 7%. Though, this isn't a fixed number and can change from time to time, depending on what the risk-free rate currently is. Risk-free rate means the return that an investor can expect to earn from a zero-risk investment, which typically is the government's treasury bills. So, when T-bills are giving a higher risk-free rate, investors would need to demand a higher yield from stocks in order for it to make sense, because higher risk, higher reward ma. And when T-bills are giving a lower risk-free rate, investors can expect to get a lower yield from stocks. So that is rule number 1. Look for stocks that have a dividend yield of less than 7%. Second, since we want the dividend yield to be sustainable, we can look for companies that have a payout ratio of under 70%, though this doesn't apply to REITs, as REITs are required to pay out 90% of their taxable earnings to shareholders. Third, the company needs to have a track record of paying steady and increasing dividends. This is quite straightforward, right? If you are planning to rely on dividend stocks for passive income, you need to make sure that the dividends are coming in every year. Plus, the dividends need to increase over time in order to keep up with inflation. Fourth, we only want to invest in companies that are profitable. So for this, we can look for companies that have a net profit of more than 10%. Fifth, we don't want our companies to have too much debt, because if the company has too much debt, it can go jibaboom and go bankrupt. For this, we can look for companies that have less than 90% debt to equity ratio. Last but not least, if you are an investor from Singapore, it's better to stick with Singapore stocks. Since Singapore has no dividend withholding tax, no estate tax, and no capital gains tax. Now, unfortunately, I wasn't able to find a stock screener that has all my criteria. So the next best choice is to use the stock screener by SGX. So dividend yield of less than 7%, net profit margin of more than 10%, and debt to equity ratio of less than 90%. And boom, we are left with just 100 stocks out of the whopping 600 over stocks in the list, which you can then apply the rest of the criteria that I've mentioned just now to further narrow down the list. But here are my top 4 dividend stock picks that you can check out. Not financial advice, of course. The first stock on this list is none other than OCBC. Now, don't get me wrong. The reason I didn't pick DBS or UOB is mainly because of valuation. Currently, DBS has the highest price to book ratio of 1.68, whereas OCBC is a lot lower at 1.19. Though, all banks are good banks, and you won't go wrong with any of them, as all of them focus on slightly different things and are sort of geographically diversified. DBS is expanding to India, UOB to Southeast Asia, and OCBC to Hong Kong and China. So by owning all of them, you get to capture the entire pie. But back to OCBC. During the first half of 2024, OCBC has increased its earnings across all its business pillars, such as increasing non-interest income and fee income, wealth management income, and insurance profits. They have also recently just completed their acquisition in Indonesia while buying over Great Eastern completely, both of which will help to boost their earnings. And even though rate cuts can lower the bank's profitability, OCBC has been investing in high-quality commercial assets, as well as increasing its issuance of fixed-rate loans to mitigate the impact of rate cuts. Overall, OCBC has been a fantastic dividend stock, with them increasing their dividend payouts over the years and is now paying around 5+% dividend yield, representing a healthy payout ratio of 50%. Next up on the list is Mapletree Industrial Trust. MIT is an industrial REIT with 140 properties across the US, Singapore, and Japan. More than half of its holdings are in data centers, while the rest are spread across business parks, flatted factories, and high-tech buildings. The thing I like about this REIT is that it has proven to be very resilient during tough times, such as during the pandemic period and the high interest rate environment, as it has managed to steadily grow their portfolio since IPO, which of course has contributed to their ever-increasing dividends over the years. Their tenant base is quite diversified across trade sectors, with almost 3/4 of tenants having leases of more than 4 years. Their debt maturities are also well spread out over the next 4 years, which will help to reduce the impact of refinancing their loans at a higher interest rate. MIT gearing ratio currently sits at a decent 39%. This REIT has a dividend yield of around 5+%, representing a payout ratio of 84%, which is very typical of REITs. Now, most Singapore dividend investors will typically add on a few more REITs to their portfolio, which is perfectly fine. However, just know that by doing so, you'll be exposing yourself to sector over-concentration risk. So when interest rates are high, all your REITs holdings will suffer, such as what happened over these past few years. On top of that, since REITs pay out almost all their profits, they will always need to issue rights in order to raise capital, which will force investors to either invest more money into them or risk getting their holdings diluted. So rather than going all in into REITs, you can also go look for other dividend stocks that are non-REITs. And for that, we have Sheng Siong. The great thing about Sheng Siong is that even though it faces a very strong competition in Singapore against the likes of FairPrice, Giant, Cold Storage, and even online groceries, it has not only managed to survive but has also thrived. That's because Sheng Siong doesn't try to directly compete against these big players, but rather it carves out a niche of its own by offering fresh produce, cheap groceries, and household brands. What I like about them is that they have a high cash balance and no borrowings. In fact, their net cash position has been increasing over these last 5 years. This allows them to quickly use their cash to buy more inventories to sell. And unlike banks and REITs, Sheng Siong is recession-proof, as Singaporeans will still need to buy groceries no matter what. In fact, from what we have seen from the pandemic, during times of crisis, Sheng Siong can perform exceptionally well, as kiasu people will rush to stock up on toilet papers and instant noodles. As more BTOs are built up, Sheng Siong will continue to expand in Singapore. They also have a few stores in China, though it only contributes to a small part of their total revenue. Sheng Siong has been consistently paying out dividends year after year while increasing them. It currently has a dividend yield of 4%, representing a payout ratio of 70%. Last but not least, we have Singapore Exchange Limited, or SGX. It is Singapore's only stock exchange operator, and as such, it has a natural moat protecting it, as anyone who wants to trade Singapore securities will have to go through them. This stock has many of the qualities that you would expect from a good company, such as increasing revenue, increasing net income, and a healthy debt-to-equity ratio. This stock has a long track record of paying out dividends. It currently has a dividend yield of 3%, representing a payout ratio of 62%. And recently, MAS has mentioned that it will be looking into ways to revitalize the Singapore market, such as encouraging its pipeline of quality listings, improving liquidity, and re-evaluating its regulatory structures. And if they succeed, SGX will greatly benefit from it. Anyway, that's all for this video. Hopefully, you found this useful. Like, share, and subscribe, as I'll be posting new videos every Monday, Wednesday, and Friday.